Through the QOZ program, QOZ funds were established to provide a way for investors to place their capital gains into projects being completed within qualified opportunity zones. Structured as corporations and partnerships, these funds look and feel like other investment vehicles you may be familiar with, such as limited partnerships or real estate investment trusts. To be considered a QOZ fund, it must meet two main requirements. The first one is that it must be self-certified with the U.S. Treasury Department. The second one is that it must hold 90% of its assets in QOZ property, which includes QOZ stock, partnership interests, or a business property acquired after December 31st, 2017. In layman's terms, this means the fund must hold a substantial amount of its assets in property that improves the economic prospects of that area. This includes investment into new businesses that create jobs for residents, engaging in development projects that improve the area's aesthetics or availability of housing and services, or substantially improving projects that already exist through rebuilding and renovations. Note that certain businesses, such as golf courses, country clubs, racetracks, or other facilities used for gambling and liquor stores, are prohibited for qualified opportunity zone investments.